There are two main types of debit spreads that I use. Vertical and diagonal. We're going to start with vertical. Verticals are easier to handle and are easier to manage, but there are some strategic advantages to doing diagonals, which we'll also talk about. So a vertical debit spread is two options with different strikes on the same stock with the same expiration. The higher priced option is purchased and the lower priced option is sold. It has to be this way, otherwise it's not a debit. Now this might be confusing. When I say the higher priced option, I don't mean the higher strike. So let's assume a calls. Here we are at 150, here's 155, here's 160. The higher priced option is going to be the lower strike, right? So this could be like $5 and this could be like $3. The lower priced option is going to be the higher price strike because it's further away from the money, right? So basic stuff there. The higher the debit spread, the greater the cash needed to purchase the transaction. The benefit is that this can be done in a cash account. You do not need margin. For this trade below, we bought the BABA 114 calls for $5.43, and we simultaneously sold the 122 calls for $1.58, creating a net debit of $3.85 or $385 per contract. And note that the expiration here on both is the same, okay? This is a vertical, if I can spell, vertical debit spread. All right, so that's that one. And then, of course, the basic thing here is that a call debit spread is a bullish position and it will make money as the underlying stock goes up. However, also note that it also protects you if a stock's going sideways from theta decay. A put debit spread is a bearish position and will make money as the underlying stock goes down. Okay, except for day trades, a vertical debit spread has a higher probability of making money at less risk than a simple purchase of a call or a put. Why? Because selling the further out of the money option helps pay for the more expensive option, which makes your break even lower. Okay, and that's kind of one of the things here is when your break even is lower, you are sharing the risk.